analysis for short-term trading. Ladies and gentlemen, please welcome Zach Mir.
Thank you very much. Just want to say that I'm slightly cold affected. I've got a bit of man flu, so if I cough and splutter, hopefully you'll understand. Getting on with the presentation. Rhetorical question, I think, really, because fundamental analysis doesn't really have any timing aspect in it at all. The only timings that you kind of know are AGMs and result statements and events like that. Otherwise, in terms of when to invest and when to get out, I don't think you have any real clues, and that's true whether you're Warren Buffett or just a beginner in the market. Where we are now, the overall view is that we've had a 10-year bull market, an asset bubble in many areas. Even Bitcoin is starting to bubble up now, so that's nice. Since 2008, when we had the global financial crisis, the economics textbooks have been written. You weren't really allowed to have interest rates so low for so long. It was feared that it would cause inflation or instability and all sorts of things like that. But we've had 10 years of relative stability in the markets. You didn't actually need to be a genius to work out that with interest rates low, investors had to get into the stock market, they had to get into the housing market, because they got nothing on if they deposited money in their bank. The other aspect that we've seen over the last 10 years is the globalization of the markets and just the interplay between China, India, the US. Obviously, we've got the trade wars now, and the trade war between China and the US just underlines how global everything is. In the old days, you'd have boom and bust because America would go into recession, that would drag Europe into recession, etc., etc. Now you have a pretty well balanced situation between developing countries, so far anyway, developing countries and the developed ones. And we seem to have a situation where we're almost in an evergreen era of relatively low growth overall, but we don't have that boom and bust anymore, which has made the markets in some ways less exciting. Volatility in the stock indices has been at record lows since, well, at least until we had the problem with the trade wars. The final bullet point there, though, I suppose, is that's my attempt at humor. In the last 10 years, you didn't have to be Warren Buffett to work out, in my opinion, that the markets were a buy on the dip, which is basically his strategy. I think that even Coco the Clown could have worked it out. It's something which is just a basic fundamental aspect of the market. But the problem is, we've had 10 years of good times. How would we know whether that situation is going to change? On what we need to know, I suppose, is market timing. We have sudden events, macro news, profit warnings, bids. That's part of the architecture of the markets these days. And as a trader, you're looking at risk management, so stop losses and targets. Where do you get those stop losses? Where do you get those targets? And after these sudden events, what do you do? If there's somebody tries to shoot Trump, do you buy the market? Do you sell the market? If there's a profits warning from IBM, is it an opportunity? Do you just give up on IBM totally? Those are the questions that you have in the market. I'm very much charting-based, technical-based, and that seems to me the most quantitative thing to do. But as you can see from that headline at the bottom of the page, Berkshire Hathaway, which is Warren Buffett's vehicle, has not done any better than an S&P tracker fund. And that's been the case for, well, at least since the global financial crisis. Before that, Mr. Buffett was doing rather well. But we are in a new era. And in fact, even Buffett himself has said, in most cases, you'd be better off ditching your fund manager, obviously a fundamentally based fund manager, and just buying an S&P index tracker. So index trackers are a technical strategy. So you've actually almost got the most fundamentally based investor in the world, or the most successful one, telling you that it's better to go for index trackers, which are effectively just momentum indicators. You're following the momentum of the market and not doing anything else. So we are in, I think, much more technical times than we've ever been before. Here's one situation where you had a technicals versus fundamentals situation. I'm sure most of you remember June 2016. There was the surprise, inverted commas, surprise vote for the UK to leave the European Union. Until that time, the market was in the FTSE 100. This is the FTSE 100. It was in a downtrend. It had been a downtrend for much of the past year. But you had that red trend line there. That's running through 6,300. I suppose what you would have said in this situation is that if the vote had been Remain, then the downtrend would have continued. But as there was a surprise in the market turned up sharply. And as soon as it broke that 6,300 level, which was, let's say, the line in the sand, that was the buy signal. And so with technicals there, in a surprise situation, they gave you the clue as to what to do. The downtrend had finished, we'd broken 6,300, and then on, let's say, the 1st of July, you'd buy into the market, and we've rallied 1,000 points and more since that time. So for me, the advantage of technicals is that they tell you what's going on now at the moment. So we had the downtrend. They're telling you what the market expects. The market expected Remain and a further fall in the market, further fall in the FTSE. But you had the surprise, and then the technical said above 6,300. If we break 6,300, the market is likely to be a buy. And you can see that the moving averages there followed the trend line break. But basically, that was a very good signal and a very clear signal from technicals. At that time, if you looked at what the newspapers were saying, what commentators were saying, they were all over the place. With the technicals, though, you just had a line break, 6,300, up we go. That's the description of that. So basically, 6,380 was the line there, roughly around that level. You have the technicals there, so the 50-day moving average rising above the 200-day moving average. Just going back to that chart, if I can. That cross there in May was the 50-day moving average moving above the 200-day line, which is a classic technical signal. So in a way, the technicals, according to that measure of the moving averages, had already decided that the FTSE 100 was going to be a buy, and that was 2 months before the rally. So if you want evidence of technicals being cleverer or more useful than fundamentals, you had a couple of signals there, the trend line break and the moving average crossing up. And so we had the result of the market rallying to 7,700. Second situation, also at the time of the Brexit, this is sterling dollar. Again, going into June 2016, we had a downtrend, or the market was topping out, coming down there. A trend line there running at 150, and some of you remember the night of the vote, when the result was released, there was a spike to 150, and as soon, on the basis that people were expecting the vote to be Remain. Remain was bullish, and Brexit was regarded as being bearish going into that situation. That line was never broken, and it was hit almost exactly, and then the market continued its move down to 120. So even before the result, you had the technicals telling you that below 150 we would go down to test the lows that we eventually did. So a line cross there, the moving average there at the end of 2015, the blue 50-day moving average falling below the 200-day line. So that was in a sell, and that remained in a sell for the whole period. So for me, it's like right or wrong, the technicals give you a clear view, whereas fundamentally, how do you quantify whether what the effect on sterling would be, whether we remain or not? We're in a similar situation now where we've got sterling at around $1.27. It's falling on political uncertainty. I don't think it's factored in Jeremy Corbyn coming into power. I think if he came into power, it would be towards parity. But the market still doesn't believe that he'd ever get in. They believe that Boris Johnson will save the day or something like that. I don't think he's any better than Corbyn in his own way. But you have setups there where, as we do now, where you've got the chart telling you one thing and the fundamentals, the convention saying that there's no way Corbyn can win, so therefore the pound should remain above $1.20. I think there are times where we've got particular uncertainty where the technicals are the leading indicator. So that's the assessment of that. 120 after the failure at 150 for sterling dollar. And we'll see now, hopefully, in the next few weeks whether $1.20 holds, because that's been the low we've had over the last 3 years. Going on to a stock here, Facebook, as you can see from the headline there, shares in July dropped by 20%. According to the fundamentals, what would you do? Was it a bargain or was it a value situation? Fundamentally, you would be buying any tech stock. We've had record highs since then for the Nasdaq. So on a fundamental rule, you'd be buying Facebook after that revenue warning. On a technical rule, like me, I suppose you'd be waiting for a signal, and we'll see what the signal was. There you had it in July. The shares were massive about turn there. They gapped down through the 50 and 200-day moving average, so settling around $170 after being as high as, let's say, 215. On a technical basis, I'd be a seller because we're below the 50-day moving average, below that blue line, and I'd stay a seller until the start of this year when the shares broke up above $140. So you had, let's say, $30 of downside there, a bit more actually, and then a buy signal with the break above the 50-day moving average. So with the technicals, you have something which is very simple. You're not having to work out revenues or whether the company has lost its edge in the market, or whether you like Mark Zuckerberg or not, or whether they're a sinister company, whatever your view of the company is. On the technicals, you're just literally looking at a moving average or two or a trend line, and that's what I think is the marvel of technical analysis. There's just no way, on a fundamental point of view, you would know what to do. The situation there was that, let's say you bought after that 20% fall in Facebook, you would have bought around $170, and you'd have to wear a loss, or you'd be offside for at least 6 months and losing, I don't know, 30% of your investment, or risking 30% of your investment. I think that the Buffett approach is great over the long term, but you can be hit if a situation or sentiment towards a company or a sector changes markedly, and that's what we had with Facebook over that period. So, as I said, $140 was the buy signal after the short around $175 on that gap. So, technicals gave you an answer of what to do. On a fundamental front, I suppose most of us are probably still as mystified about Facebook as we were in July. On to an economic situation. I know that if you're an ActivTrades trader, the non-farm payrolls would probably be the highlight of your month. There was one recently where the non-farm payrolls for April, it was the beginning of this month, it was released, came with a bumper figure, 263,000 versus 190,000 expected. On a fundamental basis, the rules are that you would be buying the dollar. On a technical basis, like me, you'd be sitting on the sidelines waiting for a signal, and see what happened after that. This is the intraday chart of pound dollar, and going into that event, you had the downtrend, and then that was broken at $1.30, so that was on the better than expected employment figure. But really, the market should have gone down. It should have been. This is pound dollar. So the the pound rising there, and the market took the results totally the opposite way to the fundamental rule. So that's the surprise there that we had with that particular situation. Just to summarize what I'm trying to say, for shock and surprise events, I think the technicals win by definition. They give you a line in the sand. They give you a strategy, which fundamentals don't do. The market is a quirky place. It factors in events and it factors in news and doesn't factor other ones in, so and you don't know which ones that it is actually basing its view on. The reason that I think most short-term traders lose money is because they don't actually follow the technical rules that they've set up. They go by a mix of fundamentals and technicals, or they just say, well, I don't believe this signal, I'm going to wait for the next one. They do things like that, and that's the reason I think that there is a problem that most short-term traders have. I don't think the concept of short-term trading is necessarily that bad. I do think that even if you're a total fundamental investor, technicals are useful for timing, and the Facebook situation there, I think, was a good example of that. That's it for my little talk today. If anybody has any questions, let me know. Okay. Thank you very much indeed.